What's up? It's Matt Atwood here, and today I want to talk about why houses still cost so much. For a little background, I'm one of the certified financial planners at TimeWise Financial, and also have been in the market for a home. As I've been monitoring the real estate market, as well as the rate hikes, I've been left wondering, why are prices staying so high? When we look at the monthly payments required to buy a home, they have nearly doubled. For example, let's look at a $400,000 mortgage. Prior to the rate hikes, a family could borrow $400,000 for 30 years and only pay $1,600 per month, as well as only pay $180,000 over the life of the loan and interest. Though with rates where they are today, that same mortgage would cost $2,600 a month and result in almost $550,000 in interest paid over the life of the loan. You would think that this nearly 64% increase in monthly housing costs will put pressure on the housing market to cut the prices so that they remain affordable to buyers. But so far they are not budging. That being said, let's dive into why exactly that is. So first we need to take a look back and look at what housing prices have been up to. Housing during the pandemic appreciated notably thanks to a surplus of cheap money due to the government stimulus and record low borrowing costs. In 2020 and 2021, housing appreciated 11% and 18% respectively. This went to bolster homeowners' balance sheets, and these increases sent demand to the moon for homes, as the herd saw an opportunity to attempt to get rich. Additionally, at the time, a buyer could make a cap rate, the term used for a rate of return on investment properties, of around 7 to 8%, or even higher. This meant anyone who bought a rental house during this time could see double-digit growth and 8% income on their investment at a time when savings accounts were paying 0.01% and bonds were paying below 1% in income. Though the appreciation has already started to cool thanks to the recent rate hikes, and housing is expected to flatline in 2023, with home values going down 0.2%. according to estimates by Freddie Mac. This is a good sign though, as the rate hikes are effectively cooling the market as well as inflation. Additionally, another factor that's keeping house prices up is supply. So as of right now, 62% of US mortgage holders have a rate below 4% and 92% have a rate below 6%. These recent sharp increases of rates have left existing homeowners in a conundrum. They can either trade in their $1,600 per month payment for a $3,000 payment or stay put until rates come back down. Most are electing to stay put, and this is really limiting the supply of homes available in the market. This disincentive to sell, though, is why the number of homes sold hit record lows this year. This is the key reason, in our opinion, that housing has stayed level thus far. But what do we expect to happen next? Well, there are a few factors at play. But one thing we can say for sure is the longer interest rates remain high, the more painful it will be for real estate investors. The main reason this is true is due to opportunity costs and uncertainty. As rates on bonds and other income-bearing investments have come up, we've seen many dollars flee into these safe investments. And we are at a time when you can make 5% yield on a property and have to manage the asset, have the risk of something happening to the property, it needs a new roof or a tornado comes through, or you can make 5% or more sitting at home doing nothing via the fixed income market. This value proposition is helping to cool demand for real estate, which allows the supply issues we just discussed to level out. Additionally, on that same front, new housing starts are hitting new highs. Thankfully, the constraints put on building supply chains during the pandemic have subsided, and new construction is on fire. New starts on multifamily structures with 5 or more units hit all-time highs this year, as young families seem to demand more townhomes, and new starts across the board are at their highest levels in decades. This should also help with the supply issues we just discussed and eventually help to bring prices down. Considering all this data, we believe if rates remain high, prices will have to come down. But that is a big if. The Fed has already hinted that they may start cutting rates as soon as next year, which would reignite demand for housing from many like me who've been sitting and waiting on the sidelines. Though there's a meaningful probability that these rate cuts may take longer than expected. Inflation actually went up in July of 2023, after a precipitous drop all the way down to 3% through June. This is a step further, the fact that it's going back up from the Fed's goal of 2% inflation, and takes us a step further from lower interest rates. Looking forward, if inflation and interest rates remain stubborn, it may not be a good time to purchase real estate with borrowed money. Cash transactions are still viable, and over the long run, real estate is still a great piece of any portfolio, and that is why each of our clients maintain some exposure to the real estate industry in their own portfolios. But that being said, if you have any questions about the real estate market or your portfolio, please reach out to us for a review. And if you enjoyed this content, the greatest compliment you could give is share, like, and subscribe to the video so that you can see future timely videos just like this. With that being said though, thanks for watching.